Hello and welcome to Kitco Mining's Digging Deep with me, Paul Harris, live and in person, well not live, but in person at the 2025 Prospectors and Developers Association Conference in Toronto in Canada. Joining me today is Joe Mazumdar, editor and analyst at Exploration Insights. Joe, welcome back to Kitco.
Thank you, Paul.
Now you've been traveling quite extensively recently. You've just recently come back from Africa, so tell us about that. What were you doing there? Who did you go and see?
So my first trip to Indaba, which is the big mining conference there, was 2 years ago. And I planned on some site visits to Southern Africa, basically looking for more copper exposure in the Central African copper belt of Zambia, but also looking at the projects in Namibia. And starting from Cape Town, where the conference was. A lot of the conference at the time was talking about what was happening in West Africa. And I published an article in the Assay about those risks and whether West Africa is uninvestable.
Because that's the question, isn't it? There's been a lot happening in Mali and elsewhere, resource nationalism, and whether it's a good place to invest still or not.
Yeah, and not only, I mean, resource nationalism, there's security risks, and now, I mean, we could call it creeping nationalism with respect to increasing the free carries. Some countries have 10%. Mali wants to do 35%. Royalties, going from 5% to potentially plus 12. And so, does it make these countries that give you security risks? Are they actually economically viable, given the imposition of higher royalties and tax rate rents? So that makes these places a little less attractive. They're attractive for endowment, they're attractive for the ability to build quickly and get things into production, but now the movement has been outside of some countries like Mali and potentially Burkina Faso to Cote d'Ivoire, to Senegal, to Guinea, but also potentially the same geology in Northern South America, more people thinking about Guyana, Suriname, and places like that.
So I imagine you spoke to a lot of people and listened to a lot of sort of panels and presentations talking about this. So what are some of your conclusions from that, let's say, research exercise, and how are you looking at incorporating that or adjusting your own portfolio as a result?
Yeah, so I'm not really touching anything in Burkina Faso or, sort of like looking for blood on the street sort of attitude with respect to investment. Because my other concern is a potential contagion of higher rents to countries that potentially don't have the security risk. As they look at their own free carry and the royalties, and they look next door and they say, well, they've got 35% free carry. We can increase our free carry by another 5% and still look better than those guys. We can increase our royalty by another 2% and still look better than these guys. So that could be more an issue than security, just a little bit of contagion. Maybe not at the same levels as Mali and potentially Burkina Faso, but a little bit more.
Wasn't that ship launched a few years ago with Barrick Gold rescuing lost projects around the world? It's, to a greater or lesser extent, it's done similar agreements with the government of Papua New Guinea, participation, Tanzania, participation, Pakistan, Tanzania, participation. I'm sure we'd like to do something like that in Chile to bring back Pascua-Lama. Obviously, the agreement with Pueblo Viejo in Dominican Republic.
Yeah, but each one is a bit different. Pascua-Lama is two countries, Argentina and Chile. Maybe the Pascua-Lama thing has been a thing since I worked there in the 90s. I'm not sure if that one is going to change. And that makes, really, for me, everything along the spine of the Andes problematic. Because the best way to build any of those projects on that part of the Andes, on the Argentine side, is send it west. Infrastructurally, and, just, it's quicker. But how that works, tariff-wise, who gets paid, that's never been resolved.
And that's the Maricunga gold copper belt.
Well, most of Maricunga is on the Chileno side, but there are stuff, there's big porphyries like Pachon that's on the Argentine side that would do much better if it was going west as opposed to going east. McEwen has switched from being a concentrate to now doing cathode, and that makes them less infrastructurally exposed, which is a good thing. But you've got a lot of big projects that are in the resource stage or feasibility stage that are still going east. because there's no agreement to go west.
Yeah, and that's obviously the Los Azules McEwen copper project you're talking about in San Juan when you refer to.
Oh, sorry. Yes. And so when we were talking, it's like, where are you going to go? And so infrastructure becomes important in terms of cost of capital, but also stability agreements, because you can have a stability agreement with one government, another one comes in, and suddenly they want to change all the goalposts. And people could say, oh, that's the third world country, but now we're seeing that in the States.
But isn't that the whole purpose of having a stability agreement? Because stability agreements typically have arbitration clauses in them that if a future government does change them, then you take them to court.
And you're suing the government and you're taking them into international court. How long does that take? And in the meantime, you're going to have to pay for lawyers and you're not making any money. Who's going to fund that?
Lots of fun.
Yeah.
Okay. Let's bring it closer to home. We are at the PDAC or PDAC. It seems to be busier this year. There seems to be more of a positive vibe here, but that's just my thoughts. What are your thoughts, Joe?
Yeah, I think, but it's a lot of industry talking to industry, because I think M&A is going to be very important. I think most of the funding for the juniors will go to projects and exploration alliances. And so that's what I think a lot of the discussion and the activities around. It's not a lot of retail and investors coming through the booth. You see how packed the core shack place is, because it's industry looking at the next play. It's, the majors taking a look at, hey, this is a project we might be interested in. Does it look like something we should do? And here's the CEO right here that we can talk to. So I think there's a lot more of that happening right now.
It's been talked about a lot that there's less money in fewer hands to fund the sector in general, and yet there's too many companies. How can these things be brought into balance? Does the industry need to cull a lot of these?
Yeah, well, it's needed to cull for over a decade. So the lack of funding, could be seen as a good thing, as long as that funding goes to the right projects. The problem with flow-through is it's not about the projects and it's not about management, it's just about a tax loss. So unless you're doing a charity flow-through with a back-end long-term holder, you're constantly at risk after the 4-month hold is taken off. So I'm more interested in the guys that could fund at close to where they're trading and not require a warrant to entice people. And so I'm willing to do that, and I much prefer just to buy in the market.
Okay, you obviously know a lot of companies here. You've walked around, you've spoken about the core shack. Is there anything that's glistening in the core shack that's caught your eye?
Yeah, it's interesting. I own shares of Southern Cross, and I like the way that's being built out. They just put out a new exploration target, which is not a resource, around their 1.35 kilometer strike of Sunday Creek. Now it's going up to about 6 million ounces on higher grade. So that's going to continue to grow because they're still in the middle of a 60,000 meter drill program. So that's the other thing that I'm looking for is big drill programs, but manageable. They're not $1,000 per meter programs where when it's tight, hard to get money, bang for buck, you get a program of 3,000 meters in a season that's only lasts 3 months. Whereas I can get somebody else that, the cost per meter is much lower and they can work all year round. So that's another thing I'm looking at. And then also with the Chinese M&A, I'm looking at jurisdictions that are compelling enough that they'll get a bid by both sides. And so then I'm concerned about listing, or actually more about domicile and whether those companies are prepared for a Chinese investment.
I was at the Zijin Mining cocktail last night, and that aspect of where to be and being Zijin, a friend of Canada, but Canada perhaps not reciprocating that all the time, was a key topic there. Now, this year's PDAC, Joe, you've been quite a party animal, attending lots of cocktails. What are some of the places you've been to, and what have you learned from those?
Well, usually, it's not just me, but a lot of people get invited to 4+ events in one night. And then you try to go to as many as you can. So I didn't go to anything on Sunday because we publish on Sundays, and so I was trying to get that out of the way. So I felt maybe a little bit guilty that I missed some. So I had 4 yesterday. I went to all 4. And so I started off in a Colombian delegation thing where they're trying to promote mining in Colombia, which was nice because they didn't have a speech. I don't like the speeches, and it was just meeting people, which was nice, and making contacts. Because I've never been positive on Colombia, especially on the open pit side, but that might change. So I'm willing to give that a chance.
Okay, let me just come in there, Joe. How can you promote mining in Colombia when you can't get an exploration concession?
Exactly. I don't have an investment in Colombia right now, but there is a project there that's private that I'm interested in seeing because of the grade. But I was interested because of that project to understand what's changed in Colombia from the Colombian government.
I think I know the one that you mean, but we'll talk afterwards to see if we are talking about the same.
Not for the audience.
Yes, it's private, yeah. Okay, and that's Colombia. Then where did you go from there?
Then I went to the tech one. And unfortunately, I did miss the speech there because everyone told me that the speech was actually quite good.
Is that Jonathan Price? Or?
Yeah, the CEO talking about the implementation of tariffs and stuff like that and how they're going to manage that by selling more product potentially to other markets, go more to Asia and other places as opposed to selling into the States. So that was something I missed. And then I went to another one in the Royal Ontario Museum by a contracting company that basically contracts out to majors in terms of geologists, geophysicists. So a lot of the majors don't want to hire their own people. And so they don't want to take on that G&A, so they hire these people to do it. So if there's no program, they don't have any people. But the problem is the intellectual property is now not within the majors. It's either in the juniors that are well run and have a low cost of capital, or it's in these companies that we've never heard of.
That would seem to be a strategic flaw or strategic deficit.
Exactly, but when you're trying to cut G&A and you cut all these people, that's all that intellectual property that's not being bred by you. Okay. And then you're teaching a lot of people middle management, change management, all these things that really don't find deposits.
The horror.
Yes, I did that.
Okay, so that was tech, and then Royal Ontario Museum. And where did you end up?
I ended up tech, Royal Ontario Museum, and then I came back and did the Chile event called Mines and Wines, which was just basically the same people I met there last year. It's just like a reunion of everybody I used to hang out with in South America in the 90s.
Well, Chile's got a presidential election coming, I think, next year. Are people starting to talk about what may or may not happen then?
Yes. Well, I mean, the impression I got the last time I was in Chile, which was, I believe, October last year, was that a lot of people have basically are not going out of their way to talk to the government anymore or complaining. They'll just wait till he's gone. So anybody submitting something will just wait. There's no point in doing it now. So I think there's a lot of optimism as most countries, when they go from one pitch to one side left, they pitch right. So most of the mining industry is anticipating a pitch to the right.
I think there's a striking parallel with Colombia there. The current government's got 18 months left, a year and a half more or less. And I think the attitudes there are pretty similar. Wait for the next guys.
Yeah. And that's worked, well in Argentina, except for the crypto thing. But otherwise, I think their investment plan for big investments over $200 million has been met like very happily by the industry, and now people want to come in. Now the junior non-cash flowing guys can actually build because they can get debt and people will lend them money. And now those export tariffs are gone. So all of that incentivizing people to build in the best provinces. The problem is that people shouldn't go away saying that everywhere in Argentina is good. No, it's still a provincial issue with respect to getting mining going, and the provinces that are bad remain bad. But the provinces that are good have just gotten a lot better because now the federal government is online.
I think you're referring to the RIGI tax incentive scheme launched last year by President Javier Milei. That's had a big uptake, not just in the mining sector. They've billions of dollars committed under that from the mining sector, the energy sector, solar, lithium.
All resources, yeah. But so I was at the tech thing, and then I've been down, as you probably know, you've been there too, to Mendoza, in supporting that their government initiatives provincial government initiatives to build out their mining sector in the south. And historically, Mendoza has been a very difficult place to work. Ban on cyanide, ban on open pits, ban on sulfuric acid, and people worried about water usage. And now suddenly, because their tax base has been, decimated and their population increased, their roads and all the infrastructure, the wine companies and the tourism can't pay for it. So they're looking for a bigger tax base. So they're looking to incentivize more foreign direct investment, and so they're looking at the mining sector, but in a place where they have social license to operate.
Argentina's cocktail is tonight. I'll be going there. I assume you'll be going there too?
No. Incredibly enough, no. No.
On that bombshell, no, we've got more. Okay, M&A. Big transaction was announced, it seems like forever ago now, but probably about 10 days. No, it was a week or so ago, wasn't it?
Oh, that does seem a long time ago.
Equinox Gold and Calibre Mining. This is two producers getting together. It's going to result in a company with a market capitalization of 7 to 8 billion Canadian. What's the like about this? What's the dislike about this?
Well, I mean, it's a different move. I mean, it's a fractal of what happened with Newmont and Newcrest in terms of scaling. They want to get a bigger scale Newmont to attract generalist investors that are looking for dividend payouts. Problematically, for me, on the Newmont side at least, they have to show a stable dividend policy to attract those people. What they could attract is those people that are looking at gold equity ETFs, and they offer them a dividend. But problematically, I don't think they can compete against the royalty companies that can offer investors limited operating and capital risk and a dividend. That's their real competition. And in terms of Equinox, they were probably sitting there not getting that next level of capital.
Yeah, because there's about, 15 companies in that $1 to $4 billion market cap range.
And then you get into, it's almost like going in, like when you're boarding a plane, Group 1 versus Group 2 versus the general public.
Oh, so they're going premium economy.
They're going premium economy, but now they're in Group 2. And they can board the plane, and then there's room for their suitcase.
This does seem to be a deal that people either love or hate, looking at some of the commentary on it. Most people seem to think that it's a better deal for Equinox than for Calibre. Reasons being, Calibre is very close to the end of building out its Valentine gold mine, and Calibre shareholders were expecting a lift in its share price or valuation as and when that comes into production. Now, if the deal goes through, Equinox will get that lift, not them.
Yeah, but problematically, if the ramp up doesn't happen as they think, and they have to go back to the markets, which this comes with a $75 million loan to help them finish it, because from their conference call, they needed another 100 million Canadian to finish it, and basically they got 75 million US. So there might have been a working capital issue that maybe they would have had to go back to the market for. And if they didn't do the deal, they wouldn't have that cost of capital advantage. I know it wasn't a low interest loan or anything like that, but that's an incentive for them to close the transaction.
Okay, debt's also perhaps a bigger issue because Equinox comes into this deal with $1.2 billion of debt.
And their whole idea is when they get Valentine Lake into production and they've already ramped up Greenstone, that free cash flow will allow them to deleverage. Deleveraging is, as you said, their priority.
And quicker.
Yeah, and I think their last big purchase was Greenstone from Premier Gold, and then they bought Orion's stake to consolidate and make that 100%. So their big thing is that we're Canadian focused, big open pits, cheap power, and stable jurisdictions, and so trying to for Equinox, take the eye off the Mexican ball with respect to Filos and some other areas that they're working at that are assets that are much smaller, maybe rattier, and now they might consider divesting.
Well, Equinox reduced its debt by several $100 million last year, so they've already shown that they're quite serious in that intent. I interviewed Ross Beatty just after that deal was announced at BMO last week. That's on our website and on our YouTube channel, so have a look at that. Now, you started this segment talking about Newmont and its divestiture program, and as you just alluded to, Equinox, when this deal completes, I think the combined company will have 11 mines and some development projects as well. So right for divestment as well. Ross Beatty mentioned as much. So when you look at it, what would you finger as the prime assets that will let go for either being too small for the new Equinox Gold or too expensive?
Yeah, well, I would think Los Filos would be an easy one just to die on the vine because they're having so many problems, advancing the project in Mexico. And it might, look for a reallocation of assets and a reprioritization into different jurisdictions. Obviously, they get more of a premium for being in the States and being in Canada, and less exposure to Mexico right now, given the issues there. Brazil probably still works. Infrastructure in Brazil is pretty good. A lot of hydropower, so cheap if they're close to grid power. So I think they got a nice base of the Americas, and because a lot of people are worried about places like we were talking about, like West Africa, to show that they're America's focus, would get them a different investor, that might just be interested in that and not in other stuff.
What about Nicaragua? One of the key production bases that Calibre brings to the deal are its operations El Limón and Libertad in Nicaragua, which have been standout assets for Calibre. Before Calibre, they're standout assets for B2 Gold, but obviously there's that sort of country risk or political risk component. Or is that sort of, diluted away because there's so many...
Yeah, the more you can dilute your geopolitical risk, the more of a premium you get on your cash flow. So I just see that being a positive. And then you could take away the Filos overhang. And then you could focus in on, because, don't worry about that, look at this. And, that was I doubt if they have a similar divestiture plan that's anywhere near what Newmont did and whether they have that kind of demand for their assets. But they're not touting a plan that's saying, the consolidation is going to cost this much, we're going to take on this much debt, and then we have a plan to pay that debt back with all these divestitures. That doesn't exist. But, it could help, but I don't think that's a big part of the deleveraging. I think the deleveraging is mostly focused in on the free cash flow from the ramped up assets.
Okay, maybe we've left the best to last, and it's perhaps something we'd perhaps rather not talk about, but we have to talk about it. Tariffs and US President Donald Trump. You published your exploration insights yesterday, and you had a section on that. Donald Trump has implemented tariffs against Canada, against Mexico. He's increased his tariffs against China. There's talk of a specific tariff on copper, similar to the one he's got on steel.
Well, he hasn't done the copper one, but he's but he's talking about that.
Talking about it.
And he's talking about aluminum and steel, as you said, and then he's also talking about reciprocal tariffs. So things that he'd missed. So, it's going to fragment economies, potentially send Canada into a recession. And maybe Mexico as well, because they were all about nearshoring, and that's at risk right now. Not a good thing for the market as well. The sentiment for base metals, industrial metals, is low. It's just gotten lower. It was low because of weak Chinese demand, but now if the Chinese can't sell to the U.S. consumer, that might be problematic. I know they're going to put out a new incentive package coming up, but is that going to mitigate the risk? The other thing that I've heard as well is that, on a cost basis, Chinese production is such a cost advantage that the Chinese were worried that the tariffs might be 100%. That was their number. And the fact that it's 20% is like a relief.
Okay, let's focus, if I may, on the copper aspect. What will tariffs on copper, if they come, what would their impact be? Would it give a boost to US copper developers?
Exactly, and so I'm in a good spot there. So finally. Like I have shares of Arizona Sonora Copper, and they're not producing copper concentrates. Their idea is to put a project together that produces copper cathode. So that copper cathode does not have to go to get smelted anywhere. It could go into the manufacturing supply chain and stay in the States. So I think that is a good way to play that. But if you are looking at a project, the States doesn't have any smelting capacity. So if you build a project in Canada or Argentina or that, it's not coming into the States to be smelted. It's going to be smelted where all the capacity is, which is Asia, and 50% of total smelting capacity is in China. That's where it's going to go. It was never coming into the States because all the smelting capacity is owned by Freeport and RTZ.
I suppose you could argue that most of the copper exported into the United States is in products.
Most of it would be, yeah. But those guys that want to make copper rod, wire, and stuff like that would have to import copper cathode.
Now, can I pour a little bit of water on your sort of copper developer party?
Oh.
Well, I've got to. Now, tariffs on steel. Mine building needs a lot of steel. Tariffs on China, a lot of the inputs for mining, a lot of the machinery, the equipment is now sourced in China. So everything else being equal, the inputs to build a mine are going to get more expensive, which, you're going to get a benefit in one hand, you're giving away with the other.
Yeah, I absolutely agree. And we got that COVID impact as well. So I wouldn't look at any technical report prior to 2020 and put any weight on it. Because the prices had all gone up probably on average 30 to 40%. But yeah, we're going to see what this implementation of the tariffs and how much of that goes to the consumer of the steel, of the aluminum, and of other products, because it's a 25% on everything as well. So we'll see how much that feeds into the inflation. I think it's going to hit inflation in the States. And then we'll see how that has the reverberation on the actual tariff policy. Because the reaction will be immediate, and it has been, in the stock market, which is one thing that Trump tends to gauge himself by, but also it will be on sentiment, because people, are more concerned about cost escalation from a consumer standpoint.
Well, this is exactly the thing. Tariffs are always inflationary. And as you mentioned, putting tariffs across the board on China. China's the main supplier of stuff that everyday people consume. And I was reading this morning that Walmart is looking at closing a whole bunch of stores because half of the products they stock come from China. And there's also questions on, this is going to directly affect the population in general, and a lot of the population don't necessarily have the financial capacity to withstand higher prices. How do you think that's going to play out?
Not well, because the thing is that you might have a lot of people that voted for Trump thinking that the costs were going to go down, but not only have the costs not gone down, they might have gone up, which I think they will, but also they might have lost their job. And that double impact wouldn't be a positive.
A lot of domestic political pressure to...
Exactly, and then the first voting machine would be in the midterms.
Somebody this morning said to me that, in their opinion, the thing that's going to resolve this and see the tariffs removed, avocados. Mexico supplies 80% of the United States avocados, and if people have to pay more for their avocados, then have avocado toast.
I was thinking tequila, but yeah, I can go with
that before, yeah.
I can go with avocados, yeah. No, but it's going to be cars. It's going to be everything. And so that is going to go into near-term copper consumption. It's going to go into near-term palladium, near-term platinum, near-term nickel, near-term everything that goes in as a manufacturing input. People will demand less. And one of the big issues with cars and demand for metal is just because people are demanding less cars. They're not buying, they're keeping their car longer, so they're going to consume less.
But again, that points to straitened financial circumstances. People can't afford to replace them.
Yeah.
Well, certainly interesting times. Joe Mazumdar, thank you very much for joining us today.
Great. Thank you very much, Paul.
And that's it for Digging Deep this week. This is Kitco Mining, and I'm Paul Harris.